Look, as investors, we know that the absolute biggest opportunities usually hide right in that gap between market expectations and fundamental reality. And right now, there is a massive expectation gap sitting dead center in Alphabet's latest earnings, all revolving around one single number that has Wall Street completely polarized. Today, in this explainer, we're going to look right past the headline panic and decode what is actually going on with Google's capital allocation. So, how is the market digesting this right now? Well, mostly with fear. If you just look at the recent price action and the analyst notes, investors broadly view Google's massive spending as this panicked, margin-crushing AI tax. The prevailing narrative out there is basically that Google is being forced to torch unprecedented amounts of cash just to keep pace with OpenAI and Microsoft, putting their historically pristine software margins at massive risk. But here is our core thesis for today. This staggering $180 to $190 billion capital expenditure, we don't think it's a short-term hit to margins at all. What we are actually looking at is the construction of a massively underpriced, long-term AI cost moat. We literally have to stop looking at the spend as a penalty and start pricing it as a deep structural advantage. Let's break down exactly why the market is sweating so much. Capital expenditures are effectively doubling, going from roughly $91 billion in 2025 to up to $190 billion in 2026. And to top it off, management used their Q1 call to explicitly warn that they're going to spend even more in 2027. Even for a company pulling in over $400 billion in trailing revenue, that is just an astonishing amount of cash going out the door. Mainstream analysts are, quite frankly, terrified. They see this purely as defensive spending. You hear phrases thrown around like spending ahead of demand because they're terrified these infrastructure costs will permanently erode Alphabet's 36% operating margins, all for a really uncertain ROI in a space that changes every single week. But let's invert the problem here, Munger style. The real question isn't actually about the absolute dollar amount they're spending. The real question is this capital a defensive tax being paid to an external landlord? Or is it a strategic investment to fundamentally alter their underlying unit economics? Because over the long run, whoever controls the unit economics wins the game. Now, to be fair, we do have to acknowledge a very valid counterargument. Yes, a portion of this spend is absolutely necessary defense to protect their search monopoly. That's true. But, and this is the critical distinction the market is missing, Google isn't just taking billions and renting third-party compute from Microsoft or just passing it right through to NVIDIA. They are aggressively building out their own vertically integrated stack. What they are actually buying is a closed-loop system. Google is actively constructing this vertically integrated fortress. They're pouring billions into their 6th and 7th generation tensor processing units, their own custom silicon. They spent $5.9 billion acquiring Intersect just to lock down the energy supply. And then they connect all that raw power directly to proprietary models like Gemini 3, pushing it out through their massive global distribution network. This level of vertical integration is incredibly unique. Unlike their competitors who are entirely reliant on outside hardware and subject to brutal markups, Google owns the factory. This is a massive reason why Google Cloud's backlog literally just doubled sequentially to an astounding $462 billion. Enterprise customers are locking in these long-term contracts because they see the stability of owning the underlying infrastructure. So why does this specific architecture actually move the needle for the valuation? Because AI is not traditional software. Traditional SaaS has near zero marginal costs. Build it once, sell it infinitely. AI is fundamentally different. Every single query, every time that model thinks to compute a response, it generates a hard physical inference cost in electricity and compute degradation. Look at the raw economic engine this setup creates. By escaping the NVIDIA markup, the data suggests Google can build up to 4 TPU data centers for the exact same CapEx price OpenAI pays for one equivalent cluster. And let's look at the actual output costs, specifically those complex reasoning tokens. OpenAI's premium hardware stack forces them to charge upwards of $60 per million tokens just to scrape out a margin. Google's internal cost? It allows them to offer Gemini 3 Pro for around $12. That massive structural hardware advantage right there, that creates a deep margin cushion. It means Google can aggressively price their premium reasoning capabilities for enterprise clients, while competitors literally bleed cash just trying to match those prices. Google absorbs the cost via TPU efficiency. Everyone else is forced to pass hardware rents on to the end user. Now, this brings us to a really crucial nuance. We are absolutely not arguing that model performance doesn't matter. Of course it does. But we have to ask a practical business question. As this technology matures, Is absolute benchmark-topping performance going to remain the only metric that dictates market share?
Google's implicit strategic bet is clearly no. They are betting that the AI wars are going to shift from a pure research race for the absolute smartest model right into a utility phase. And in the utility phase, enterprise adoption is won by the provider who offers a model that is highly capable, sure, but radically cheaper.
And you know what? We are already seeing this play out with massive token subsidies. Say you have an enterprise processing 10 billion tokens a month. A heavy reasoning workload on OpenAI could cost $500,000 or more. Google, weaponizing its low internal costs, can drop that total cost of ownership down to roughly $70,000, or even offer the first few months entirely free. They are directly stealing market share simply through superior unit economics.
Now, you might push back here. You might be sitting there saying, come on, the market isn't blind. Investors are already well aware that Google builds its own TPUs. And you would be 100% right. It's definitely not a secret. However, merely acknowledging the existence of vertical integration is vastly different from accurately pricing its long-term impact. The market sees that $180 billion headline and immediately reacts to the short-term cash burn. What they haven't accurately valued is the permanent, structural shift in corporate unit economics that this silicon actually provides. If our deduction holds water, the market is entirely mispricing this massive CapEx as a brute force operating expense. In reality, it's cementing a physical, hardware supply chain advantage, a true silicon moat that pure-play software companies simply cannot replicate, no matter how brilliant their algorithms happen to be. And the proof of this is already starting to show up in the actual financials. This is exactly why Alphabet's operating margins actually expanded to 36.1% in Q1, blowing right past estimates, despite being in the middle of this incredibly heavy spending cycle. The underlying economic model of their AI business, backed by their own hardware, is proving to be so much stronger than the consensus fear narrative suggests. Ultimately, as AI inference transitions from a shiny novelty into an everyday commodity, the company with the lowest structural cost basis is going to capture the vast majority of the value. Viewed through that lens, Google's $180 billion CapEx looks a lot less like a desperate defensive tax and a whole lot more like the foundation of an impenetrable fortress. It's an absolutely fascinating shift from software moats to hardware moats, and exactly the kind of structural advantage we need to be paying attention to. Keep in mind that the above content represents my personal analysis and opinions, is intended solely for educational and discussion purposes, and does not constitute any investment advice. Please make your own independent investment decisions and bear your own risks. Thanks for joining me for this explainer, and I'll see you next time.